What's up, everyone? I'm going to be going over something I created, the beginner's guide to trading. Just kind of go over what's the difference between trading and investing and all that fun stuff. I just want to remind you guys that this is not financial advice. I am not a financial advisor. Again, this is education, not financial advice. I'm a trader just sharing what I've learned, not a licensed financial advisor. There's nothing here personalized advice or recommendations for you guys to buy anything. This is just my process and how I do it. Trading always involves real risk. You can lose money, including your whole account. That's happened to me before. So please do your own research and never risk money you can't afford to lose. So things that we're going to cover today: the basics, the markets, making money, mechanics, charts, risk and mindset, getting started, and I don't know if we have a Q&A. So what is trading really? Trading is buying and selling to profit from price movement, right? What you normally hear is, I want to buy Tesla at 200 and I hope Tesla goes up. Now, there's a huge difference in this, and I'm going to talk about it, right? So you can profit whether money goes up and down only if you're trading yourself or you are a trader. If you are investing normally into the stock market or anything like that, you do not make money if it goes down, right? That's a big difference. A lot of people talk about investing, but when you invest in mutual funds and all that type of stuff, you only make money when it comes up. And I personally don't like it, but it can, over time, obviously it works, but I don't think it's the best way, right? That's not my thought process. And you see how it says market is just where buyers and sellers agree on price. This is not true. Price is run on an algorithm, and we'll kind of go over that today. I'm actually glad I left that in there because that's my viewpoint on price because of what I've learned. That's not true. Okay, so investing versus trading. Investing is more of a long-term horizon type of thing for years. You own the asset, but you're betting on growth over time. Low effort. You can say low stress. It depends on how involved you are into it. And then it's a little bit more hands-off. Now, trading, short time horizon. It could be minutes, could be seconds, could be weeks, could be a month. And you're trying to capture price moves. It is higher effort. It is higher skill. I wouldn't necessarily say it's higher risk. It just depends on your personal risk structure and what you like and what you can manage. Again, it's an active skill that you build over time. Again, trading took me roughly 6 years to understand, but that was my timeline. That's what I needed. So why people trade in the reality check, right? So people trade because it's flexible. It's an income skill. You have independence and you can kind of master this craft and scale it to like whatever you want. Like the amount of money that you can make is endless, but same with losing. Let's not just only focus on the winning side. Like there is risk involved, but you lessen the risk with anything when you understand what you're doing. The reality is it does take years to get good, and rushing in to make money is how most people lose money, and that's exactly what I did in the beginning. And the people who make it treat it like a skill to learn, not a lottery ticket of getting out of a situation. That's how I was treating it in the beginning. And so why I got into trading: early expectations versus reality, right? I got into trading once I left the NFL. A lot of people don't know about that story. I was with the Rams in 2020 and I was like, this is not for me. And so I left, and, trading fell into my lap. Is something that I was interested in. And I believe God placed it there for me. And I also wanted to, work on my relationship with God. I felt like it was transactional, or it was like, God, I need you now, instead of like having an actual relationship with God. And that's kind of a separate story, but it kind of combines all of this and like what kind of really got me into trading. So I first started off with making money. Luckily, the market was just going up. It was actually in Bitcoin. I was talking with a friend the other day. I had turned $500 into $4,000, and people were telling me that it was going to go higher. So I held and I lost all of it. And then I invested $800 more and lost that even quicker. So that was my story. And it goes even before that. Before I started really learning how to trade, I had got $1 million demo account, and I was trading some type of, I wish I could find the screenshot. I can't even find it anymore. I was trading like JP something, maybe GJ, which is a forex pair. And I went to bed, woke up, and I was up like $52,000. Now this is obviously a demo account, but I had no idea what I was doing, and this was in the first couple of weeks. So imagine that the bug bit me really early. I was like, oh, you can just go to sleep and this happens? Bet I'm doing this. Reality, it took me 6 years to get to this point where like I can look at the market and kind of understand what's going on. So the type of markets that you can trade, you don't have to learn all of them. I would focus on one. Once you understand how a market trades, you can trade any one of these. You can trade stocks, indices, forex, commodities, futures, options, cryptos, bonds. So I mainly focus on futures. Futures is where I do most of my work in, is right there. And then here it kind of has like the indices. It would kind of be very similar. I started with forex. That's like kind of where I got in, and I don't really go anywhere else outside of that. But once you understand this skill, you can trade all of these assets, and it'll be something that my mentor ICT talked about was, let's say right now in the indices, this market is stalling or it's consolidating. Then I will look for a market outside of crypto. I will look for a market that's moving. So maybe gold is moving. So what I've learned and how to read the market in the indices will then transfer over to commodities where I can trade gold. So that's a good thing about this skill. Stock and equities. You know, this is owning a tiny piece of the company or of a company. Those are small shares like Apple, Tesla, Netflix, all the things that you hear where people are like, oh, I invest in stocks. I don't necessarily like this path unless you're like really, really long term and you already have a whole bunch of money. That's kind of where I would start with this. Because stocks are, let's say Apple is $200. I don't really know what it's trading at right now because I'm not into the stocks. But if it's at $200, then for one stock, you got to pay $200. And again, like I said, you only make money if Apple goes up. If Apple goes down, you make zero money. This is why I don't like this type of trading, but it still can be profitable. Indices, my babies. This is where I do most of my work, is in the indices or futures market. So the one that I specifically trade is the NASDAQ. NASDAQ is the one that I specifically trade. I just like it. It usually is quicker, has more of a range, and it's like tech stocks. So it just works for me, right? That's just why I prefer it. But you have the S&P and you have Dow. So again, this is a lump sum of companies. So NASDAQ 100 is 100 companies. The Dow is, or US 30, there's 30. And then the S&P is like 500. I don't know if it's actually 500, but it's just a collection of stocks. And usually, you know, some big name stocks are in there. Then you have Forex. This is where I started. It's a country's currency versus another one. That's essentially what Forex is. And that's where I started. Again, it's the largest market in the world because it's actually like money is getting converted almost every day and exchanged, right? So it's not just like trading, it's actually like worldwide market, right? So if a company needs to buy something in and let's say that other currency, like they're going to do it through that. Like that's, this exchange market is always moving. That's why it's the biggest one. That's the term that's used for how it's moving up or down, 10 pips, 20 pips, 30 pips. So commodities, this is the real stuff. Gold, silver, oil, natural gas, wheat, coffee. There used to be an orange juice contract. There used to be lean hogs and all that type of stuff. So this is real thing. So when people say like supply and demand, which I don't necessarily believe in this market, it is for sure, right? Because if you have no wheat, there's an issue, right? There's going to be more demand on something. So that's where you have real supply and demand. In the other markets, there is no such thing as supply and demand. It is controlled by an algorithm. This is still controlled by an algorithm, but there's more emphasis on supply and demand because if there is a shortage, or let's say there's a shortage of coffee beans, like that's a real thing. You can't just like magically appear coffee beans out of nowhere. That's important, right? And gold again is seen as a safe haven. So when the dollar is kind of in Yamin land, that's where most people are going to flock to. When the US dollar is being challenged, they're going to be putting it in gold. Futures, again, like I said, it's, to me, these are like very similar to indexes. So I don't really want to go too crazy into this, but it's essentially the same thing to me. Options, right? This is also another place that I got into early on in my career with trading, which was options, which I like if you want to get into stocks. This gives you an opportunity to buy a piece of it, but for less. So you have calls and puts where you can make money where it goes up or down. Remember, if you just buy a stock, you cannot make money if it goes down. Options, you can make money if it goes down. So put puts on like Apple, if you think it's going to go lower to a certain price and you make money as it goes lower. Now, there's a whole bunch of other things that you have to learn. You have the delta, the theta, the time decay, and all that type of stuff, which I don't really remember at this point because I haven't done it in a while. So there's a lot of extra options or features or things that you have to kind of learn along with trading options. But again, it's cheaper. So if Apple is trading at $200, if you're trading the stock, you have to put $200 in just to own one. Now, if you're trading options and you're buying Apple, and Apple, let's say, is $200, and let's say I want to buy, say I think it's going to go higher, so I'll buy a call, and I think it's going to go to $210. Let's say I can buy one, and let's say it's for $120, which you'll see on there, it'd be like 1.20, which means it's $120. I get 100 shares of Apple at $120. So as it goes higher, then obviously I make money. But again, in the money, out of the money, you have all these other things that you have to worry about, which and it's not my expertise, but I do know a little bit about options. Crypto. People love this market. This is not my favorite market to be in. Not because I made money and lost it. It has nothing to do with that. It's just, it trades 24/7. You know, it is time-based. Again, this is not random. It's time-based. But I just don't trust this market, right? So you have Bitcoin, Ethereum, and I don't even know how many they have now, but most of the scams you see happen in this market. So let's be real about it. Bonds, again, this is you lending the government money. They can pay you back. It depends. You can trade bonds, or like you can do the stuff where you can buy and sell. But then also you can buy bonds, which is you loan money to the government. They pay you interest, and it's like you have 10 years, 30 years, bonds, 5 years, all that stuff, and 15, I think, year bonds. So this is more of like an investing tool. I mean, you can actively trade it, but this is not something that I am involved in on a daily basis. So single assets versus funds. You have individual assets where you're buying Apple, or you're buying Amazon, or you're buying Bose or Boeing or whatever, right? You're buying those things. Then you have mutual funds, which are a collective group that usually you have to go to like Fidelity or I don't even know, Goldman Sachs and stuff like that. And that's where you'll invest in a fund. Again, you only make money if it goes up. That's the only time. And to say that the market always goes up is ridiculous. It is less work. Yet I remember millionaires are not made off of funds unless you already have a whole bunch of money. You have to take some accountability of your future if you're trying to learn to invest, right? You can't just give it to other people and they don't just make millionaires. That's not how that's done. Nowhere is that done. So again, mutual funds, this is what I was kind of talking about. You have mutual fund, ETF, index funds, all this type of stuff. Again, this is where you give your money to other people and they supposedly grow it for you. Now you have trading styles. Now we're going to start getting into like what I specialize in. You have scalping, day trading, swing trading, position trading, and then you have investing. Scalping is like when you're in and out in minutes. Day trading is when you're looking for a trade to happen throughout the day. It could be 5 minutes, but it could be an hour, 2 hours. It could be the whole day, depending on your strategy and all that stuff. It just depends. Again, swing trading, you're holding for a couple weeks usually. It could be a couple weeks or a couple days. So like what my mentor taught me was one shot, one kill. So that's like 2 to 3 days is what you're looking for. Position trading, holding for months. Again, this is like when you're buying, let's say in January, say looking to get out in 3 or 4 months. That's kind of what it is. And again, remember, investing is long-term, years, right? Which does not fit my personality. I am more of a day trader. So how you make money, long versus short, or in options, it would be calls versus puts. And again, this is only if you trade your own money. When putting this into mutual funds, ETFs, and all that stuff, there is no long versus short. They only buy. Going long is buying. Like I love how it says buy low, sell high. They make it sound like it's very easy, but you have to know what you're doing, right? You don't just buy every low, you don't just sell every high because you get ran through. It's crazy. And so when you're going long or you're buying, you buy, and when price goes up, that's when you make money, right? And it says, you see how it says the intuitive one, most investors only go long, because that's what most investors only know how to do, and that's where most things only make money, going long. Where I have the ability to make money if it goes lower. So selling short is you profit when the market drops. This is how I try to make money in, let's say, down markets or downtrending markets. Again, sometimes this is hard to explain to some people, where it's like, how do you sell something you don't have, or how are you buying something you don't have? You're pretty much looking at the market and saying, I believe it's going to go up, or I believe it's going to go lower, and then you put your money on the line. Essentially, that's the best way that I can explain it to you, right? But going short is wanting price to go lower, going long is wanting price to go higher. So fundamentals versus technical analysis. So you have studying the why, earnings, news, economy, interest rates. Long-term investors usually lean this way. The fundamentals, like, I'm gonna be honest with you, price is time-based. So it's time and price. You'll notice how, and I'll show you an example. The news is a smokescreen. This is what I've learned. The news, it's smoke screens. It's already priced in. That's why they cannot tell you before and after, and why people who have learned from who I've learned from, the guy ICT, can predict where market's going to go next before the news even arrives. Like, we don't need that. That just lets me know when price is going to move. That's all I care about. I don't care what it says. You know, they're going to tell you after the fact that, oh, it did this. There's been days where where the news came out good and price dropped. Like, explain that. They can't. Because it's already in the market before that happens. That's why you're able to predict, right? We don't chase. Technical analysis, again, studying the chart. I've underlined price patterns because you have people that are price pattern learners, but they're looking at the pattern for pattern's sake. I'm not looking at a pattern for that sake. What time is it forming? That's all that I care about. The time. Time and then the price. When those align, price is going to move, and you'll see what I'm talking about a little bit later. Again, reading the chart, again, you don't need to stress out about mastering this now. You just need to understand what they are. So you have green candles or up close candles, or for my instance, the green candles are gold on my chart, and the red candles, which you usually see, are down or gray on my chart. That's just the language that the price moves with. So time and price is the key indicator. I'll repeat that again. It is the key indicator on when to buy a certain market. You have candlesticks that show the open, high, lows, and close for a period. So if you're on a daily chart, every candle will represent a day. If you're on a 15-minute chart, every candle represents a 15-minute chart, and so on. And that's the time frame that you see there. You have the 1 minute versus the daily. And then the market condition is price generally going up, down, or sideways. You are a risk manager when you are trading, and your whole goal is to protect the account first. You need to make educated decisions and protect the account. So risk per trade, you should be risking a small amount or a small percentage on any trade. For me, I personally risk $200 to $300 per trade. That's all that I'm willing to risk, and that's around 2 contracts or the micro NASDAQ. That's pretty much what I trade. So a stop loss is necessary. If whomever you're learning from does not have a stop loss, I would run away as soon as you can. Risk to reward, you usually want to make it 2 to 1, 3 to 1 usually. If you're going 1 to 1, you got to have a really high percentage. The risk to reward is very important, because if you have a 3 to 1, you can be profitable with a 33% win percentage. Listen to me again. With a 33% win percentage, you can be profitable in the market if you have a 3 to 1. And again, you will lose some trades. That is normal. If you are afraid of losing, you will not be able to play the game. That's just the rules of the game. You're going to lose. Trust me. And it took me a while to accept that. A time that risk management cost me, what I do now, poor risk management, it's cost me so much money. Because you want to be right, and you just want to keep investing, revenge trading, and all that type of stuff. Versus what I do now on Top Step, on my funded accounts, they have a lockout mode. So when I know I'm feeling myself to get into that mode where it's not good, I lock myself out. And after I win, I lock myself out. So I cannot go back in. This protects me from making impulsive, emotional decisions. And I understand that when I lose $200, I'm done. Important for me to have those parameters in before. So again, trading psychology, which is the hardest part of the charts, is you. Not the chart, it's actually you. So fear and greed will challenge you in the markets because you feel like you didn't make enough or you're scared to lose. So that's even worse, right? Fear is going to hurt you more than greed. I'm telling you right now, it will. Chasing losses, revenge trading, that's how you blow accounts. That's how you lose like all your money, is that. Again, discipline. Boredom is often a good sign. If you heard in my vlogs, it's boring, right? Trading should be very boring because you should be looking at the same thing. It shouldn't be so exciting. It's the same thing every day. And again, a plan removes emotion. So if you have no plans, you're trading on feelings, and that is going to hurt you 100% of the time in trading. I learned to control my emotions because I had a plan. I go and do the same plan every single day, and that's what's helped me stay consistent, which I'll show a little bit about today, and also how the trade I took today and how I prepare for the week, right? Because you have to have some type of thing that you do, or a routine that you're doing every single day or every single week, right? That's what's so important to this whole thing. Consistent traders prepare, they don't wing it, right? I have a routine that I do every single week. I know exactly what days I'm going to trade on. I know what days I'm going to avoid. I know exactly what time I'm going to be looking for the trade to happen. Those are things that are very important, which a lot of other people don't talk about. Now, my mentor, ICT, has endless content on it. So you can go learn from him. That's who I would personally tell you to go to. So journal your trades. They know what they're watching and what to ignore. And then preparation matters more than any style of trading. Even if you know what I know, if you are not prepared, don't know what to do, it doesn't matter. Or you cannot control your emotions, it won't matter. So here are some common beginner mistakes. They are risking way too much on one trade, for sure, using way too much leverage according to their account size, trading with no stop loss and zero plan, so they just wing it. They're chasing hot tips and hype. So their friend the other day told them that this was going to happen and blah blah blah, or they hear it on the news, so they just buy it. I don't do that. Over trading and revenge trading. That's how you churn your account to almost zero, and then quitting after a few losses instead of learning from them. So what most people do is they repeat the same mistake over and over and over again, and they can't understand why they keep losing. They don't understand why their account keeps going lower. Those are things that just continue to happen, right? If you don't look at your losses and try to understand what happened here, right? And so then we're going to get into how to get started safely. So it says practice with fake money first before you even get to there. What I would say is go create a free account with TradingView. Have a journal to write and understand where you can improve and what you've learned from, and then learn from someone. Find someone to learn from. That is so important. Find someone to learn from. And again, pick the market that fits your schedule. There are certain markets that move around different times. Right? If you want to trade gold, gold can sometimes have moves in Asia, which is in the afternoon, which is at like night, like 8 to 9 p.m. You can get moves there. You have the indices that move, or futures that move at 9:30 a.m. That works for me. You can trade forex where, let's say you're up in the morning and the only time you can really trade is London. Okay, cool. Well, London is from 2 a.m. to about 5 a.m. And if that's the time frame that works for you, trade Euro and USD, and you can find setups there. Like you make it fit your schedule. Demo trading / paper account, but I would not start practicing because you don't know what you're doing. You're going to build bad habits. Don't want that. I would pick one market first, and then I would sit here, learn from somebody. Like just go learn from somebody. I would even cross these off. Pick one market, open a TradingView account, just look at it, just kind of see how it moves, and then learn from somebody. It doesn't have to be me, it can be ICT, anybody. Then again, you don't need to know everything to start. You just have to start learning. You have to start somewhere. Remember, always, this is not financial advice. Make your own informed decisions. And then we're kind of get into how I break down the market. So this is how I start my week every single week. This tells me the exact days I'm going to be trading on, and this tells me the exact times I'm going to trade. We have core CPI at 8:30 on Wednesday. Thursday, we have core PPI at 8:30. Friday, we have news, core retail sales, 8:30 a.m. And then you have prelim, UOM, consumer sentiment, 10 a.m. So when I look at this calendar, I see how I have it where I only have red, orange, and I have the gray folder. Gray folder tells me if it's like a holiday. I only have USD because that's what I'm trading. If you're trading pound, or pound is here, or euro, or Canadian dollar, Australian dollar, whatever, Zealand, that's where I would change. This tells me exactly which days I'm looking at, and again, time. Remember, I was talking about time and price. So now we know that Wednesday and Thursday and Friday are a focus. This looks like it's floating, right? Just like it's in the middle of nowhere. I don't know what's going on. I'm looking at these candlesticks and it's just doing it, right? Again, we all will start there at some points. And I'm sorry, I know this is a very, very long thing, but I'm trying to squeeze and give as much information as I can in this video. And again, if I have to do another one, I'll do another one. This is where the week started. So I'm just going to put some key levels on here that are going to make no sense to you guys. Key days of focus for Wednesday and Thursday. What time? 8:30. Have our open hours or business time will be 9. Okay, so Wednesday, Thursday, and we could put Friday. Those are our days of focus, Wednesday and Thursday. So we're going to box out Monday, Tuesday, Wednesday, Thursday. What are our days of focus? Wednesday, Thursday, Friday. So I don't trade this day. I don't care. I don't care this day either. Now, let's look. This is Monday. Tuesday, again, this is the 15-minute chart. So every candle represents 15 minutes. What time did this occur? Look down here. 8:30, right? You see this long wick and movement happened at what time? 8:30. A trade in here, and I lost. I expected to go higher. Okay, it's cool. What was the next day that I was expecting price to move? 8:30. I care about what's going to happen. When exactly am I looking for price to move? Look down here. 9:30. This is the 9:30 candle, and guess what happens? Straight up. I expect this on Wednesday, but we didn't get that on Wednesday. Okay, fine. I'll just look for the same thing the next day. Time and price. That's all that matters. And so this was the trade I took today. This is how I look at the market, right? You need to have a plan visually. My plan was no trading on Monday, no trading on Tuesday, trading on Wednesday, Thursday. So we lost this one. We lost here. Then we won here. And what I lost here, I made back and some here. Not over leveraging, just knowing what I'm looking for. Notice the most dynamic price action, exactly what we were expecting. That's why I say it's not random. It's not buying and selling pressure either. But again, there's many ways that you can trade. This is just my process of how I look at the week, what I'm looking for, and then knowing what I'm looking for and then executing. So I know this was a quick breakdown of what I personally do. Again, I'm not trying to go into depth what I do and what I look for, because I learned from ICT. This isn't my own stuff. Learn how to do this for myself, because mutual funds and all the ETFs, they're not doing it like this. Guarantee you. Don't know this either, unless they've learned from him. And if you stayed this long, thank you so much. And I know that you are potentially interested in this or just supporting me, and I appreciate both of that. So again, I'll catch you guys on the next video that I make. Hope you guys have a great day, a great week, a great month, a great year, whenever you're listening to this. And I'll catch you guys on the next one.